How are you, folks? The Enzo DiCostanzo podcast, and this is March 18th, 2023. What an eventful week it's been, or last 10 days in banking. So anybody who's a banking analyst, or like I am, who studies banks and follows the banking industry and what the Federal Reserve does and what the central banks do, this was quite a week. So let's get right to that material. Okay, so obviously the bank that's on everyone's lips, right? The words on the lips of everyone is uh, the Silicon Valley Bank, all right, which was basically a bank for venture capitalists. And uh, if you look at the services, wire transfers and clearing and settling services and things like that, certainly credit or loans, the people need those services, and certainly technology companies need those services. And I don't know if any of you have ever been to uh, that part of Northern California, the Santa Clara, San Jose area, between San Francisco and San Jose. But it's a very beautiful part of the country. The temperature, the environment is perfect. If you want to go live someplace where there's perfect weather. And it's funny, my aunt lived there for a number of years and came back to Newark, New Jersey for some reason. So I never could quite understand that. But uh, long ago, like in the 60s, in the 1960s, I guess in the 70s, she lived there with my cousins. And I don't know why they didn't stay out there, but they came back east. Um, but so anyhow, so it wasn't mom and pop customers and things like that. It was people who, not, you hate to say, well, people can afford to lose. No one can really afford to take losses, but certainly people who maybe won't be as impacted as somebody who's living check to check. And I hear statistics that it's a very high percentage of this country that if there was a $400 emergency, that they wouldn't have the $400. It's like 50 or 60% of the nation, or maybe like 60% of the people living in this country have that circumstance. Okay, that's quite a wake up call to all of us. And that's a healthy thing is not so. Okay, that's not a good situation when so many people are in that kind of a circumstance. But anyhow, so SVV, it's a financial group. It's lost tens of dozens of a percentage of its market capitalization, or the value of its equity. A company's the whole value of the company is the debt number plus the equity number, which is what's reported in the press all the time. Subtract out the cash, and that's generally around the enterprise value. And then, if these banks are going to get acquired, a deal's got to be struck to pry the shares away from. And let me tell you about those stories, right? Pry the shares away from the current shareholders. So yeah, well, I have a graph somewhere of this stuff. I didn't pull that out because I plan to talk about. I briefly plan to talk about this, but I graph this, and we'll do like maybe another video where we'll go through the graphs and the sort of the profile of the bank and what it is. But just to say, to let everyone know, there's certainly a significant and several significant events happened. Signature Bank, another one, Applied Credit, or something like that. But I had a list of them in one of my documents instead of going fishing for them right now. But there were several banks. First Republic, they're coastal banks. I don't think any of these banks are in Missouri or Mississippi or anything like that. In the area, Valley National would be a similar bank to certainly aren't the JP Morgans and the Citigroups and what have you. But actually, what I wanted to focus on was what's yellowed out, and we'll do that in a second. But it says it's a tech focused. A Silicon Valley Bank is a tech focused lender. It lost nearly $2 billion selling assets, following a larger than expected decline in deposits. You've got to see, for a bank, the deposits are liabilities. For all of us, our deposits are we consider them our assets, and they are. I mean, you've got to look at which side of the transaction that you're talking about. But if you're a bank, deposits are liability, and unless you've got the cash to cover, which most banks generally do not, unless you've got the cash to cover all your deposits, a lot of the deposits are backed up by financial instruments. And if you're forced to sell them at a time you didn't expect to sell them, you could be selling them for a loss. That's basically what happened with Silicon Valley Bank. It says a bank loses billions in value. That's really not being able to meet its it's the same old story. It's what happened in 2008. It's the savings and loan crisis from the 80s. Any kind of problem is one party can't meet the obligations or its commitments to another party. That's generally all crises that we have out there, or something like that. And there was a swath of U.S. banks. It's investors on shares and a swath of U.S. banks after the tech folks lost nearly 2 billion. So Silicon Valley Bank and other similar banks, and I have not a complete list, but I have several of them that I worked on the graphs. Do I have that stuff here? Where is it? Where is it? Where is it? I did it somewhere. It was really late one night when I did it. So let's see if it's here. Index, S&P. It's not here. Where did I do? This is the Gates problem. It's not there. Maybe it's under economics. Oh, yeah, I'm surprised that I can't no, it's not that. This is something else. It's not here. That's not there. This is the live one. This is the Gates one. Time value of money. It's definitely probably not here. I mean, I forget where I put that. Let me see if I can recall. Video probability. Oh, it's probably here. Yeah, the regionals. There we go. Yeah, so Silvergate, First Republic, and we have the graphs somewhere around here. And you can see that I put the graphs up actually here. Where are the graphs? On the right. I think on the right side. Sometimes here is not here. No. There they are. So you can see it falling off a cliff. 74% decline, and Silvergate 86% decline. Now they bounce back a bit. Silicon Valley Bank 53% decline. The value, the confidence of the investors falling off a cliff. All of them. And notice how it's not just one bank. They all have a very similar shape, all very similar behavior in terms of valuation by the shareholder community that's out there. Okay, so all very similar is what that is. Man, we're going to do Treasury today, so but again, I don't want to get, because I'm going to do another video maybe either tomorrow or Monday where I go over maybe a little more of the details. But here, what I did want to focus on is what's yellowed out here. It says the 4 biggest U.S. banks lost 52 billion in market value Thursday. That's market value is the aggregate value of the shares of the equity in the bank. It has really nothing to do with the debt number for the bank. It has to do with all the now most banks, it's maybe 30. A healthy company has 30 or 40% debt, maybe 25% debt, something like that. But I don't know what the debt ratios are, the debt to equity ratios for the bank. But it would be debt plus equity in the denominator and debt in the numerator, and you find that ratio. And like I said, it should be about 25% or so. But like I said, I didn't prepare to discuss that, but I did prepare to discuss, which says the 4 biggest U.S. banks lost 52 billion in market value. Well, what are the 4 biggest U.S. banks? Bank of America, Citigroup, right? Wells Fargo and JP Morgan. And to sit there and say, well, how much is that? Is that a big deal? I mean, obviously 52 billion to most of us is an astronomical amount of money, but let's compare the, no, it says in market value. Let's compare that to the market capitalization of those banks and divide this by 4. So just doing estimations, let's say all the banks lost about 12 or 13 million of market capitalization. And I laid them out for you guys already. Here's Wells Fargo, Bank of America. So I laid them out, so we're not clicking around trying to find everything. I just use Yahoo Finance, believe it or not. And the reason I do is the historical data is a little easier to get here. I haven't used Google Finance in a long time. I've just struggled to find this link in Google Finance. I'm not going to spend video time on it right now, but I've struggled to find that. So here, let's look at market capitalization. That's the up to Friday's close of the market, because today's Saturday. JP Morgan was the market cap, the aggregate value of the equity or the stock price, with the stock price times all the shares outstanding is 384 billion. So if they lost 10 or 12 billion, that's 10. What would that be? So if this was, let's see, 10% would be 10. So 30, about 30 billion would be about 10%, and a third of that. So about 3 or 4%, they lost about 3 or 4% of its value. Okay, or so, and I think, and it's down even further since then. Okay, it's down even. I've seen all those banks, J.P. Morgan and what have you, maybe year to date have lost maybe 7 or 8%. Actually, we could just quickly look at it here. This is from, I guess, its peak in January. Whoops, from its peak in January. Peak in January, it was worth share price 140. It's down $15. So yeah, it's not 15%, but it's that 7 or 8% decline year to date from January to now. Again, also in terms of try to measure or compare what's a $10 billion, $10 billion US dollar valuation loss, you can look at the financials and just look at the assets very quickly. Just go to balance sheet. I went to financials and then balance sheet. So this is not 3 billion. This is 3 trillion, folks. You see, it says numbers in thousands, 100,000, 100 million. So not 3 trillion with a T. So, or 3,665 billion. If you had $3,000, you lost $10. How much would you feel that? So that's a way to look at it. So in terms of judging, Wells Fargo, very similar, 143 billion in market capitalization. And I just forgot what were these guys again? This is 384, Bank of America 225, Citigroup, the smaller 188. This was 1980s. This is Salmon Brothers and all that. So they're a big bank. Yeah, believe me, 88 billion is nothing to sneeze at. But and if you look at the financials and you look at their assets, what are they? I don't think their assets are in the trillions. Or yeah. 100, 1,000, so it's 2 trillion. Yeah, they have 2 trillion on assets. So that's how you measure this. You go look for the assets of all these banks and things of that nature. But certainly, I mean, it's a bit of a hit, but it's in the low, it's a fraction of a percent of the low single digits of. So if Citigroup lost 10%, or if Citigroup lost 10 billion of its okay, well, Citigroup's a little more serious. If they lost 10 billion in market cap, or 8, even if it's 8 billion or so, that's about 10% of the value of the company. So for Citigroup, it's a little more. The smaller you of a market cap you have, and you lose 10 or 12 billion, it's a bigger hit. Bank of America a little bit further away, JP Morgan a little bit further away, Wells Fargo a little bit further away. So I guess Bank of America would be second, and Wells Fargo would be third. So it'd be JP Morgan, Bank of A, Wells, and then Citi. Okay, that's sort of in terms of market capitalization, but you can order them in assets, and some of that might repeat the order and things of that nature. But that's what you want to be able to measure like that. That's what you kind of would like to measure on. Anyhow, so yeah, so we looked at this, and so the Nasdaq Bank Index, not just biggest decline since the pandemic, rolled the markets a couple of years ago. Shares of Silicon Valley Bank. So all these banks are holding companies, and there's another company that holds a stock. And there's a whole discussion as to what a holding company is, and we can get to that in another video. Like I said, if I just go over my notes from the week, I generated about 4 or 5 different notes this week. That would be a lot of lecture material for that. And it says, okay, so that lost 60% of its equity share value of the equity, market value of the equity, disclosed after disclosed a loss and sought to raise another $2 billion in fresh capital by selling new shares. I don't know if that happened or didn't happen, or if another bank is, because somebody's got to come in and do that. So in terms of, it's sold and everything's fine. Well, everything's fine because someone did this. The problem is the same people holding the shares don't have those shares anymore, or those shares aren't as valuable, or they sold those shares. That's sort of really the trauma of what's going on here. And if you look here, this was, let me see, March 9th was a Thursday. All right, so this was a Thursday right there. That's a Thursday. And I don't know if it's for the week or whatever, but certainly from relative to the beginning of the year, PacWest lost 25%. This is probably the week. First Republic lost 17, or the day maybe. Schwab 13, Bancorp 7, and Morgan lost. Yeah, that's probably for the day. That's a lot for a banker in the next to move 5%. And I think we discussed that in the last video about the S&P 500 and how much it moves in the day. And really, what's going on here is a consequence of the Federal Reserve's aggressive campaign to control inflation. So by increasing interest rates, they've caused the value of existing bonds with lower paths to fall in value, and the banks own a lot of these bonds, including treasuries, are now sitting on giant unrealized losses right there. I could put that in big print, but that's what happened. That's what happened. It's that simple. It's that simple to say, oh, well, what happened? That's what happened. It says large declines in value aren't necessarily a problem unless they're forced to sell the assets to cover the deposit withdrawals. Most banks aren't doing so, even though their customers are starting to move their deposits to higher yielding alternatives. Yet few banks have run into this trouble this week, sparking fears that other banks could be forced to take losses to raise cash. Like I said, so deposits, which are liability of bank, if you can't cover them with cash, you're gonna have to cover most of them are covered with some kind of financial security. And if you've got to sell that to liquidate, then that's where the problem could come up. It says it would book about a $2 billion after-tax loss in the sales of investments in seeking to raise $2 billion by selling a mix of common and preferred stocks. The assets and deposits almost doubled, and again, assets and deposits. In other words, to the bank, it's a liability. Okay, but also they're backing that up with some sort of either cash or some sort of financial instrument to, they take customers' capital, they take customers' cash and do something with it and try to do a better job of getting a return than folks can do on their own. Pay the depositor a fraction of what they've earned, and the bank generally keeps the rest. And there could be a big difference in terms of what the bank gains and what the depositor gains. Those numbers could be large differences. It says into U.S. Treasury, really government sponsored debt securities. Soon after the Fed began raising interest rates, that battered the tech startups and venture capital firms in the Valley, sparking faster than expected declines in deposits, and that continues. So in other words, if you've got to make good on your deposits, you got to make good on your liabilities, and you're selling instruments at a loss to do so, that's where the problem came in. So some venture capital investors have advised startups to pull the money out of Silicon Valley Bank, saying liquidity concerns, and that's the favorite word of people when they hear these kinds of things. And like I said, this goes on and on. Some accounting terms available for sale and held to maturity. The guy who won the Nobel Prize in economics, believe it or not, he wasn't an accountant. He was he's an economist, and he studied the behavior of these kinds of instruments on balance sheets and what banks do with them, and how the banks what do banks do with an available for sale security or held to maturity security, and then how successful or not successful are the banks are based on how they manage these classifications of financial instruments. That's basically what I won the Nobel Prize for. It says people are waking up to the gravity of the situation. This was one of the biggest financial euphoria episodes. This is the first sign there might be some kind of crack in the financial system again. So whatever, some chairman or chief investment officer of some capital management firm is making that comment. Again, we're not going to go through the definitions of all this stuff today, but what an unrealized loss is, what a realized loss is, and those kinds of things. Those are things unrealized profits and losses and realized profits and losses. Being able to read a financial report, what the Federal Deposit Insurance Corporation is, and again, repeating what these classifications are, folks. Repeating what these classifications of instruments are: held to maturity, available for sale. There was a deposit boom during the COVID era with these banks. So domestic deposits at federally insured banks rose 38% from the end of 2019 to 2021. FDIC data showed over the same period, total loans rose 7%, leaving institutions with large amounts of cash to deploy in securities as interest rates were near record lows. Okay, so the banks are still lending out, but they're not earning as much from. I'm saying they're earning from the loans, but they're earning much from their own trading for their own book, which is as much a part of banking as anything is, and you have to do it in a smart way. Okay, and that's where these guys did not do that. And when you have people from previous financial crises managing your bank, I mean, what do you think was going to happen? And we'll leave that comment as is with that. It says U.S. commercial banks of U.S. government securities surged by 50%. So, and I've looked internationally; it's that kind of a number internationally also. So the fair market value was much lower than if these guys held some of these instruments, to term. And it says. And here, this is looking at Bank of America. It says most of the unrealized investment losses in the banking system are at the largest lenders. Bank of America, marked that on its books of $524 billion. But again, I mean, you've got a balance sheet that's measured in trillions. I'm not saying that half a trillion is insignificant, but certainly you can absorb it better than a much smaller bank with maybe tens of billions of dollars, maybe $100 billion on the balance sheet or thereabouts. So if you're a $100 billion bank and you're losing 50 or 70 or whatever the numbers are, it's the smaller bank you are, the more amplified the impact of losses are. That's generally true. And then it goes into some of these other statistics. It says most of the liabilities, 89% of them are deposits at Silicon Valley Bank. Bank of America draws its funding from a much wider set of sources, including long-term borrowings, and 69% of its liabilities. Or so, yeah. So to compare to Bank of America, 9 out of 10 customers dollars are backed with deposits, or 9 out of 10, 9 out of 10 dollars of liabilities are backed by deposits or have deposits as a part of it at Silicon Valley Bank, where Bank of America 7 out of 10 are liabilities or deposits. Again, deposits for the bank are liabilities because they have to give you your money back whenever you demand it. It's a Silvergate, and big banks hold a range of assets that serve companies across the economy. Right. And minimizing the risk of downturn in any one industry will cause them serious harm. So they diversify. The big banks can diversify their holdings, have investment committees, have a little bit of a wider view in terms of what's going on. And it says it right here. It says other unrealized losses weaken a bank's future ability to meet unexpected liquidity needs. That's it. That's what happened. It says risks that are most acute for small lenders. Smaller banks must often pay higher deposit rates to attract customers than the mega banks do. Bank of America paid on average about 1% on deposits, and SVB, Silicon Valley Bank, had to pay double that. Okay. And it says, who are the customers of Silicon Valley Bank? The tech crowd, the venture capital crowd, private equity firms. So these are very financially sophisticated people that are far more on top of their earnings, even on just a deposit, than most people are. Total deposits rose 86% in 2021, and peaked at 198 billion in the quarter. This has got to be, that's not the industry. That's Silicon Valley Bank. It says, and the deposits fell 13% in the final 3 quarters of 2022 and continued dropping this year because, and one of the commentators on Fox News or Fox Business had said it, when bad things are happening to your customers, and bad things are happening to all of your customers they all have the same sort of characteristics, and they're all sort of similar industry, and it happens that all 8 or 9 out of 10 of your customers, they're all pulling money out of the bank at the same time for the same reasons. So that's the problem. It says there's a slowdown in public and private investments over the past year, downgrading it to one notch above junk. All right, the debt securities declined in value substantially. These guys had fair market value of available for sale at 26 billion, and which is about 3 billion below their cost. And I'm not an expert on the accounting rules, of the moment, but when you have to disclose those and when you don't, that's a conversation for one of our accounting lectures. So yeah, and Silicon Valley Bank said the following: it's sold substantially all of its available for cash securities. It decided to sell the holdings and raise fresh capital because they expected to continue higher interest rates, pressured public and private investment markets, and elevated cash burn levels from the clients as they invest in their businesses. Okay, so they're sort of telling you, what and what, why they did what they did and why what happened, those kinds of things. For sale securities. It had a balance sheet. Again, this was less than 100 billion balance sheet of securities that were classified as held to maturity. That label allows the Silicon Valley Bank to exclude paper losses on those holdings from both earnings and the equity statements, which are important financial statements. Read the footnotes. The fair market value was 76 billion, or 15 billion below the balance sheet value. Right, the fair value gap was almost as large as their total equity. So, like I said, we would need all the financials in front of us. Okay, but certainly this is not a big bank by any stretch. I mean, you're looking at banks that measure assets or balance sheet items in the trillions, and this is 16 billion. Okay, again, 3,000 trillion versus $3,000 versus $16. Right, so to just give a perspective and a comparison. And some of the debt securities have no risk of default, Fannie Mae's and those kinds, and a market risk or systemic risk. We all participate in that, including an interest rate risk, because the bond values fall and interest rates rise, and managing that, and staggering payouts and when you think your customers are going to need need their deposits back and things of that nature. And it mentions here the yield on the 2-year Treasury recently topped 5%, up from 4% at the end, 4.5% at the end of 2022. We're going to graph the 2-year Treasury, and if you guys notice, we have that, so it's good we sort of mentioned this. So we're here. So yeah, this is a 2-year Treasury constant maturity. We will going back to 2018. We'll graph that. And it says that some investors got a nice payday Thursday from Thursday's decline. Some 5.4, 5.5% of Silicon Valley Bank's available shares were sold short. So short sellers profit by borrowing and selling the shares of a company they believe to be overvalued. So if you're buying the shares back recently and the shares have declined, but you sold them at a higher price, you're obviously profiting from that. And that's basically what that says. Far fewer investors are betting against the tech-focused lenders' peers. The short interest was 2% at Third Bank, 1% at State Street, and it says 1% at American Express. Okay. So not as much with this. So yeah, so this is the shares that were sold short. This was 5 out of 100. This is 2 out of 100, 1 out of 100. So not that much. But that's what happened this week. So I gave you a little bit of a summary of that. But actually, what I wanted to talk, and there's more that I could have spoken about here that I didn't. But what we really wanted to talk about today was what is the U.S. Treasury? What is that? Okay, it was created hundreds of years ago. 1789. The government department responsible for issuing Treasury bonds, notes, and bills, and we'll have a discussion as to what bonds, notes, and bills are. We'll have a discussion about that. Okay, whoops. There. Among government departments operating on the Treasury umbrella are the IRS, the Mint, the Bureau of Fiscal Service, and the Alcohol, Tobacco, Tax and Trade Bureaus. Key functions of the Treasury. Now, again, what does the Treasury do? What does the central bank do? It prints bills. It prints the stamps. It prints Federal Reserve money. It prints money, mints coins. Like the Federal Reserve, Federal Reserve notes are dollars, but Federal Reserve notes, collecting taxes, enforcing taxes, managing all government accounts and debt issuances, and overseeing U.S. banks in cooperation with the Federal Reserve. So the Secretary of the Treasury is responsible for internal monetary and financial policy, including foreign exchange intervention. I think we had the that's FOMC. Wait, what page is this? This is page 37. So I'll go back to it easily. So this is at the end. We're here. So central bank. We spoke about this last time. I think they print money though. These guys, the other ones print the notes. These guys print the money. Regions, budget policy, financial services, fiscal stability, supervising, regulating, fine, all that. Quantitative easing. Yeah, we spoke about all this last time. Federal Reserve is a central bank, interest rates. Yeah. It says the Treasury issues coins, the Fed prints and manages paper money. That's where it was. So I knew it was one of those. Like I said, I always want to make sure. So again, the Treasury does the notes, they do the money printing. So this again, printing bills, printing postage is what it does. Federal Reserve notes, minting coins, collecting the taxes. Okay, that's so again the differences between those bonds, notes, bills. That's basically Federal Reserve notes, that kind of thing. So it's this listing. It's these securities that are up here. It's a government department in charge of managing all federal finances. It collects taxes, pays bills, manages currency, government accounts, public debt. It enforces finance and tax laws as well as Treasury bonds, considered the safest and most liquid securities in the world. Yellen was the former chairperson of the current Treasury Secretary, and I guess the first one to hold both positions. Yahoo for on that one. So it's a cabinet level department responsibility for promoting economic growth. That's the big word. I mean, really, the both of them. I mean, the Federal Reserve tries to create the conditions, and the Treasury tries to promote the economic growth. But the Federal Reserve wants to create the conditions for economic growth. Okay. It was established by the first Congress, which convened in New York, and we had a group of students. We took pictures by the first by the where the Hamilton statue is down on Wall Street. From the ratification of the Constitution, the Secretary of the Treasury is nominated by the President must be confirmed. So yeah, and folks, again, it's in your interest, especially people who are new to the country, to spend some time reading the Constitution and the different articles. That's important that you guys understand sort of what the difference is, between how this country is supposed to work, not necessarily how it's working right now, but how it's supposed to work. The Constitution was ratified in 1788, replacing the Articles of Confederation, under which the U.S. had functioned during and immediately following the American Revolution. The Constitution provided a much stronger federal government, and establishing the centralized Treasury Department was an important part of that. Here's the Hamilton discussion. He was the first Treasurer, the Secretary, and served until 1795. So he served a bunch of years. Among his major accomplishments, he was Secretary for federal government assumption of the state's debts related to the American Revolution, provision for the payment of the war bonds, and institution of a system for the collection of federal taxes. The Internal Revenue Service, Lincoln, and Lowenstein wrote a book, Financing the Civil War. Lincoln implemented an income tax to pay for the Civil War. In 1862, created the position of Commissioner for the Internal Revenue. The tax was repealed in 1872, but the office lived on. So the income tax, as it exists now, was ratified in the 16th Amendment to the Constitution, and the IRS assumed the responsibility for the collection and enforcement of taxes. So 40 or 50 years later, half a century later, we need to collect some taxes. Right. And so it began. Right. And so again, read the 16th Amendment and what it really says. I have it somewhere, but you guys can read that at your convenience. Okay. We're not going to talk about the FOMC today, but that's certainly something else that we want to talk about. Lincoln, we spoke about that. Treasury bills and bonds. The borrowing is done through the issuance of short-term notes called bills and longer-term bonds. Now, again, the printing of these were physical pieces of paper at one time. That's what the previous discussion was when it said notes, the notes and the bills and the bonds. That's what they're talking about. The money, the cash gets printed by the Federal Reserve. It says Treasury bonds are backed by the full faith and credit of the U.S. government, such as popular investments by governments, companies, and individuals worldwide. The Federal Reserve buys and sells bills and bonds to control the country's money supply. And yes, it sounds very innocent what this is. Right? How innocent does that sound? But it's not. Okay, that's what we're wrestling with right now. We're wrestling with all this content right now. All right, the bills, the bonds. All right, you want the words to sort of jump out at you. And what are we controlling? We're controlling the money supply is what we're trying to control. Okay, who runs it? There's a Secretary of the Treasury, Yellen, nominated by the president. Yellen is a Treasury Secretary, and she's Federal Reserve Chairman for a couple of years in the mid 2010s. She's the first one to hold either position. Yahoo, okay, and her top deputies, whoever that guy is, and confirmed by the Senate. Fine, whatever. So Obama 3.0. That's all I can say. Obama 3.0. So, but yeah, so there's the Treasury. Okay, again, issues Treasury. This is the debt part: bonds, notes, bills. Okay. And again, the IRS is a part of the Treasury, the Mint, okay, Alcohol, Tobacco, Tax and Trade Bureau. Okay. It prints postage, the notes, it prints the coins, collects taxes, enforces tax law, manages government's accounts and debt. So it's the Treasury does that. It says right now, manages all government, so U.S. government accounts and debt issuances, and oversees the banks in cooperation with the Federal Reserve. Okay. So you have some idea with the Treasury. All right. And now we're gonna run off to our graphing here. So this, we're not gonna need that right now. Probability, we need this thing. We're not gonna need that right now. And again, so we had the space in here. So and actually what I want to do, if you guys don't mind, just clear out all the borders. There. Okay, well, we have the data in there, so we want the 2-year yield is what we're looking for. So all right, 2-year note. And we can do the daily version of this. And you can see these are much higher now because interest rates have increased, you know, over the last 12 months, right? Went from near nothing to trying to, control inflation, control inflation. So, okay, 18 January the 1st. All right, so you've adjusted. So obviously, this the big recession here, not the big recession, but this was the COVID. Obviously, that was COVID. The gray spot there. So daily, we'll do daily. We'll do download into Excel. It always takes a minute for this stuff to download. But again, as you're looking at the Federal Reserve site, so there's a lot of good stuff that's sort of sitting for us there. Now, again, unfortunately, and folks, forgive me for putting you through the nuance of doing all this, but we have to go through. And again, there's probably folks out there, especially in the graduate course, that you guys know how to do this a little bit quicker than I'm going to be doing it. But we have to go through all of this and get rid of those dead dates in there. We can keep it. It's just the date and the yield is all this is. We can even keep that stuff smaller. This is just the day after Christmas and things like that. And all this information up here, market yield and where it came from, I already took care of that. So we sort of jumped ahead just a bit. Almost done with this, folks. Sorry, I know it's a little tedious dealing with this, but And there you go. Sorry again, sorry folks for I know the tedium of it, but and then it's all the way up, and we'll see how this is behaved. So we'll pick this off, copy, we'll drop into now. This is all set up for you guys already. We'll clear that out. So yeah, so you can see the dates are formatted, and this is the yield. It's a percentage, but it's the yield. So 5 years ago, we had a 2% yield, is what we had. Actually, we have to come down here. I'm sure we have to fix the some formatting here. Yeah, there's a little bit of formatting here. We're going to fix the, and this is we're going to paste the formatting in there, and we're going to take this all the way down. Yeah, one. You have about 1,302 pieces of data, 1,300 pieces a day. You can see where we are now. We're at the fives, and so and what's happened here. So let's look at just March, if we could. Yeah, just March here. Yeah. So what's been the movement? So from about 4.9 to 5 to 5 over. So obviously on the 8th, which was Wednesday, it was really heating up. And the reason you have the yield moving as much as it's moving, as the yield increases, that means capital's flowing out of this particular market, right? Because there's an initially there was just before the and I'll tell you why it's reduced here. Here you were anticipating a maybe even a 0.5% increase in yield. So there's capital flowing out of that bond market looking for higher yield. So that's why the prices were lower. So you had a bigger percentage return, a bigger percentage market yield because you were paying less for these instruments. But after it was determined that there was a banking crisis and the Federal Reserve might not be increasing interest rates as much, more capital piled in, and these particular instruments, the instruments that were as is that were already sort of issued, that's why you have a decline, actually really a decline on the 15th down into 3.9% territory. You had more capital piling in, saying, well, interest rates aren't going to increase that much, so we better grab the bonds that we have right now. And the prices went up, and then as the prices went up, the yield went down, but it's fluctuated a bit. So in other words, holding interest rates constant or holding interest rates even, the reason the yield goes up and down is obviously when it's a bigger yield, capital flows out, less demand for those particular instruments. When the yield shrinks a bit or declines, more capital flows into the bonds. There's higher demand for those higher prices. The higher price means you're paying more for the same cash flows, and hence you're going to have a little bit of a reduced yield. And really, we're talking on the 2-year Treasury, a few trading days, 5% swing for something that hasn't really moved that much in the last 5 years. For something that you can see here, you're talking about 0.1% returns. 1%, 2%. So that's you're talking about 20 to 25% of the magnitude of these yields moving within a couple days. That's a lot. So we're gonna make a graph of this. And also what we're going to do, and like I said, we're not going to be able to partition every single one of these, but the rate change that we're going to look at next is the following. So this is the yield change, and we know it's percentages. Rate change as a percent, 0.02%, and so as percentage points. So in other words, this is 0.0194. This is you add 2 more zeros to that, so you're getting those kinds of changes. So this is just the delta in percentage of the change in the bond yields. That's really, and you'll say Control V. Okay, and I realize you're sort of cutting it off here a bit, but so, and you can see here, 0.57, 0.3, pretty big swing. That 0.27. That's his percent. And you can see most of the average and percentage points change is very low. It's not those kinds of numbers. It's not, half a percent, 0.5, 0.5 of a percentage. It's certainly not for something that's 2 or 3%. And you have, you're moving, we say 0.5%, 0.5%, but 0.5% for something that's 2 or 3 or 4% is a big change. Now, the percentage change is this rate change divided by the original yield. Now that's as a percentage change. And you can see you had a 1% change, and you're gonna have much. As we go down to recent days, you'll have a much bigger number. All right, look at this: 12%, 6%, 4%, 5% to something that's. Whoops, you look back previously. Sorry about that. You look back previously, the change is a half a percent or 1% once in a while, but very low, sub 1% changes most of the time. And sometimes you have 2 and 3%, but not too often. Like here, you get 11 and 16. You get some big swings here. You can see generally these very small changes in the percent. But again, what you have to do is you have to take the monthly average of those numbers, which we'll do that right now. So here, usually want to do them at the bottom. So let's check out February. So this is going to be take these two numbers, copy, paste, equals average. All right, so it's moved 0.03 percentage points. And then the percent change, the average change is about 0.75% change, right? The average percent change is about. So if the average change about 0.75%, and now you're moving 4, 5, and 6%, you're way past the average. And once you have these, now you can just come through here and just you can do January's. But what you need to do is you need to come through and just block off like that last. Whoops, you want to block off what that last month is, that kind of a thing. Yeah, like that. Okay, let's see what December looked like. Yeah, you had whatever. You had 0.17, about a fifth of a percent, negative fifth of a percent. So you can see what these look like. And what you do, you just come through. You clear those. And again, let's see a couple years ago what these things looked like. Like I said, you should go through. I'm not going to do it because it's just repetitive, but you should go through yourselves and work out these all these changes yourselves with all this. You can see, so 5 Januaries ago, again, a half a percent change, not that much of a change. But that's how you study, folks. That's volatility. That's how volatility is studied. So the folks with statistic, again, about a quarter of a percent. Once again, with statistical background or you like statistics like I do, you're comfortable with it. But you could see, a tenth of a percent, 0.2 of a percent, very small changes. Okay, so you're seeing the behavior, and you could go back in time and check these out. Okay, and also what I want to show you, because we if you look at the lecture last time, we had the S&P 500, and then we had the Treasury here, the market yield on Treasury. This is the same process. I'm not going to just repeat myself with this. So what we'll do is we'll take this graph, we'll copy it, and I'll scroll over to where my data is. And I'll just sort of drop the graph off up top. This is going to be, and you're going to make a few changes. This is 2-year, right? Treasuries is what this is. You're going to click on the data, and you could just drag them over, right? Or just rename your BN and BM, right? So instead of BD, it's BM. Just click it in there. And instead of BE, BN. And you got to change how far down by a little bit that you're going. But now what you have is, and again, these are going to be lower, so we got to sort of adjust this a bit, format the axis. These are all automatic, which is fine, but the minor unit, let's do, okay, the minor unit is 0. Okay. Yeah, we could leave like this. Major units a percent. That's good enough. But we have to go back to the bottom and see how, because I think these go down a little, and you could sort of grab the corner, which I hate doing that, but or you could just reprogram. So you're down to 1320. All right, this is 1320, and this is 1320. And then you can go to design, edit, edit. It's no longer a 10-year, 2-year security. We just made a few little changes, and we have our, it's instead of going through the shading and the axes. So what you should do is you should go back to the previous video, and if you needed a refresh on this, but I'm just showing you how to sort of shortcut your way. I hate to use that word, but how to shortcut your way to when you have all similar graphs and similar units, it's a percentage and a market yield. So, and instead of just dragging this, you can cut this. You can slide over here and just drop it right below, right there. And there you go. You have 2-year constant maturity is what you got. Okay. And it's a little, and this is a little bit longer, so you're exposed to interest rate fluctuations a little bit more than you are here. That's why it's a little more steady. But so the next lecture, we'll do the 3-year bill, which is next, and then what we had. So yeah, I have to add. So I have to add some of the graphs in. But if you look here, I apologize for that noise. Sorry about that. 10-year, 2-year, 3-month bill. And then here we start subtracting. We have the 10-year minus the 2-year, the 10-year minus the 3-month Treasury, crude oil prices. Okay, so we're going to start sticking some of that stuff in here too. Okay. So there you go. See, a little more exposure. We talked about what the Treasury was. We talked about what the Federal Reserve was. We talked about the Silicon Valley Bank a bit, like I was talking about in my live classes this week. So there you go. So you had a little more exposure to this, and we'll make another video either Sunday or Monday. I'll make another one that talks about, I guess, the differences between the Treasury and the Fed. And I myself include, I think that would help if we did that. So yeah, we did Treasuries here. So I got rid of that thing. Yeah, what's the difference? We'll get to what the difference is. So you're out there with that. And this, we just did this one. I did the 2-year. And we're down to one graph, okay? And then we'll do, we could look at a Federal Open Market Committee. We'll look at something like this. This will be another video. We can talk about that thing, okay? What a central bank is, and some of these other, the repo thing, I threw that stuff in there, but that's a little more advanced. That's all open market operations, but what the federal funds rate is, that's important for us to get. And then the difference among the bonds, but yeah, we have there's a lot of good stuff here. Like I said, even though, and there may not even be a lecture for every single part of this, but however many lectures I make, the final exam will be these 120 something pages. You're responsible for reading all of these, so please, spend the time and do that. Okay. All right, folks. Thank you for your attention to this, and we'll see you soon.